Five, four, three, two, one, zero.
Hi, everybody, and welcome back to yet another cracking installment of the Matt Brown Show. This is the Built in New York series. With me on the line is a great founder doing something really hard, which is why it's so valuable. But his name is John Measy. He is the co-founder of Vero Technologies. John, welcome to the show.
Thanks for having me, Matt.
Privilege is all mine. So I always ask on any of these series, it's really just for our audience around the world to get to know like how this whole story began. So why don't you start with that? Like, what's your background? Because I know it's quite an interesting background that you come from, and maybe use that to springboard into the beginning of the origin story of Vero.
Yeah, absolutely. I would say my entrepreneurial itch is something that I unintentionally found in college, having started an educational technology business during my time at University of Michigan. Ultimately took the conservative path into corporate finance after school, mostly because that's what my dad wanted me to do, I guess. But quickly learned that working as a role player in a large organization, where even if it was a very cool job, wasn't going to do it for me. So from there, I went to a smaller asset management company, and still recognized that even in an organization of 250 people, I really wanted to see the daily output of my work translated to results. And so after some soul searching and a whole separate process that I'll spare you, I ran through, I ultimately joined a Danish software development company where I was helping them incubate and launch new products that ultimately we spun off as standalone fintech companies. So I launched 2 businesses with that group and was able to really learn what company building and taking ideas from 0 to 1 look like. But ultimately got to a point where I needed to do it for myself. I needed to have skin in the game and know that what I was building was really my baby. And so having got exposure to a very, very unique but large niche within the supply chain financing space, specifically inventory financing for dealers of manufactured goods, I partnered up with my co-founder, Isaac, and we started building Vero about 2.5 years ago.
So, John, that's a very interesting background. So, with Vero, there's actually 2 elements to this, isn't there? There's Vero Technologies, which we'll get into. Maybe we'll start there. But then you've also got something called Lever Auto, which is, according to my notes here, auto lenders spend over $200 billion a year in inventory finance. So this is the kind of space that you play in. So maybe let's start with the problem. So let's start with Vero Technologies, and then we can get into Lever Auto. So with regards to Vero, like, what's the problem from your perspective that you're solving?
Yeah, I mean, there's really, the ultimate issue is it's not a very sexy space. And as such, there's been a lack of innovations, both in terms of new operating systems for lenders who do inventory financing to use to support their day-to-day operations. But also there's a concentration of players because of the lack of systems, the lack of general human capital expertise. Not many people play in the space. And so without much competition, ultimately that means there's not competitive pricing, customer service leaves a lot to be desired, and you still have major players running their businesses on archaic technologies. So we set out to build an operating system for inventory financing providers that would not only allow current players to optimize the way they do business, but would also open up the gates for new players to enter the market.
Mm-hmm. So how big is this problem? Like, what's the market opportunity? This is for all of our investors who are like, how big is this thing, or how big could it get? What's the number, would you say?
Yeah, I mean, when you're looking at dealers of manufactured goods broadly, that's not just auto, but RVs, power sports, agricultural equipment, zero-turn lawnmowers. There's about 15 other verticals. where you have manufactured goods that are distributed through dealer networks. And you're looking at anywhere from 700 to $1 trillion based on, I should say 700 billion to $1 trillion in terms of what those dealers are spending on wholesale purchases every year. So it's a really massive market. And obviously there's a variety of different verticals within it. We chose auto to launch in first for a variety of reasons, but have since moved into RV, agricultural equipment. Power sports is going to be next.
So there's two elements to this conversation. One is the inventory financing software piece, which basically fixes a lot of the systemic issues that incumbents have created, let's just say. And then there's the lending arm, right? So you're a car dealership, or you need to finance some kind of movable asset. That's where Lever Auto comes into this conversation, right?
You got it. So really what prompted us to create Lever Auto is the fact that, and I have scars from this from my prior roles, but building institutional grade operating systems, building a financial operating system in a vacuum without having a development partner who is testing and putting dollars through your systems on a daily basis ends up creating a lot of waste, because you build something that works great in a vacuum, but when you go to operationalize it, something breaks. Or you try to do product development through a sales cycle, which obviously is not iterative enough to really get dialed in. So we decided to launch Lever really as the first client of Vero. So Lever has been lending for the last year and a half. We funded more than $50 million in wholesale purchases on behalf of our dealers. And the product insights, the feedback we receive from our dealer clients, the reporting we have to maintain as a lender have all been critical in really driving our product roadmap and allowing us to iterate on that operating system very efficiently. And it's ultimately allowed us to get a operating system which is now at a stage where we can actually license it to other lenders.
Right. So let's stick with Vero for a moment. So when we talk about poor systems and risk management processes and customer services to dealerships and things like this, like how have you guys changed all of that? Because it seems to me like when you're trying to, I tried to buy a car recently, and in fact, in pretty much my entire life, every time I've tried to buy a car, it sucks. Like even sell a car, like the amount of paperwork it takes to sell something, it's next level. Like, and I went to this dealership here in Denver here with my wife. She wants to get this Telluride. Yeah. So it's a nice car, right? And walked into the dealership, and my wife points out to me, she goes, see all those, like, it's like A4 pieces of paper hanging on the walls. She says, you see all those papers on the wall, those are all new car sales. And I was like, shit, well, you could take all of those pieces of paper and times by 10, and there's still a lot of process stuff that seemingly hasn't changed. I mean, like, whether you're buying in an emerging market like South Africa or in a developed market like the US, seems to me, being a consumer of this space, as many other people would also recognize or be familiar with, it's like, it sucks, right?
It's not fun.
So how are you improving all of this?
Yeah. So, obviously from the retail perspective, that's a whole rat's nest that we have ambitions to tackle, but not quite there yet. So what we focus on is providing systems and tools for our dealers, who are ultimately the borrower here, to finance or acquire their inventory more seamlessly, manage their cash flows while the inventory is sitting on the lot. And then when they sell the vehicle or the RV or the power sports unit to the retail customer, be able to manage their financial operations. Because when you think about these dealers who are selling hundreds, if not thousands of units every year, it's a cash in, cash out business. Most people don't understand that. When they drive by that dealership lot down the block, those dealers don't typically have cash in their inventory. That's financed by a third party. And in the case of Lever Auto is that third party financing partner for all the inventory that's sitting on a dealer's lot. So in terms of the documentation requirements, being able to create workflows that enable suppliers to submit funding requests, dealers to manage their population of inventory while it's on their lot, and then ultimately to facilitate that retail sale transaction. There's a lot of moving pieces, and our goal is really to help dealers manage a smarter financial operation with a variety of different tools and analytics, but also make sure from a risk management perspective, obviously as a lender who is, their loan is secured by that asset while it sits on the dealer's lot. So when your collateral has four wheels or can float, it can disappear pretty quickly. And ultimately, we've come up with a variety of different tools and tactics to help our lenders monitor their collateral more effectively.
Mm. So would it be fair to say that it's pretty much the same issues? You have retail and then commercial fleets. It's almost the same thing, only you're playing on this side so they can provide a better service to the end customer at the end of the day.
Exactly. One mantra we have is we want to keep our dealers out of the back office doing paperwork and on the floor where they can service their customers and sell more cars.
Got it. Cool. And just a question on, you mentioned workflows. Is that kind of like what you've done here? Is this about building a workflow automation tool for dealerships?
In a way, yes. It's just a small part of what we've built. So as it relates to any inventory financing lifecycle, you ultimately have suppliers who need to get paid for the inventory that they're providing to the dealer. The dealer needs quick access to capital to fund those purchases, but they also need to manage their portfolio of inventory because obviously the longer it sits on the lot, the more interest it accrues, which cuts into their margins on every asset that gets sold. And then from a lender's perspective, you need to be corresponding with both of those parties, or really all three of those parties need to be corresponding collectively to make sure that wheel keeps spinning as they're buying and selling cars or boats every day and every week, and it's coming and going. It's that operational intensity that is effectively why so many banks sit on the sidelines from playing in the space. It's not like a mortgage where you originate a loan and it's going to sit at the same place for 20 or 30 years as it amortizes off their books. We're talking about a dealer buying and selling a car, which typical turn time is roughly 60 days. So that's a lot of origination volume, but a lot of funding and payoffs and short duration paper. So you have a lot of dynamics that require workflow systems and generally document management systems, portfolio management systems that allow you to dial in on the vast amount of transaction activity that's being affected on the platform on any given day.
So this is about automated decisioning then, isn't it? It's about reducing time to value essentially for these stakeholders.
Absolutely. Everything from processing applications efficiently during the underwriting process and when you initiate that relationship with the dealer to handling individual funding requests that are coming from dozens of different parties. And then being able to make it easy when a dealer does sell a car to report it sold. And, they're typically waiting on financing from the retail finance company who's supporting the consumer's purchase. So there's a lot of moving parts, and making it very easy and intuitive to manage that is really core of what we've developed for all three of the stakeholders in any transaction.
Perfect. So how do you guys make money then? I suppose on the Lever Auto side, is it a percentage based on the $55 million that you've issued through that platform? And then on the Vero Technology side, is that pure SaaS?
So it's a little bit of a unique approach from Lever that we've actually tried to marry or bring over to Vero. So many of the legacy players in the space typically charge interest on the capital that they've used to fund inventory purchases, but they also used unit-based transaction fees. So for every car that gets financed, it's $80. On day 30, it's another $50 fee if the loan is still outstanding. On day 60, it's another $50 fee. Dealers get hit with a $20 administrative expense to process a title on every car. So all of these ancillary fees ultimately build up and create a lack of transparency. Generally, it can almost double the dealer's cost of funds relative to their nominal interest rate. So what we rolled out is a subscription-based program where a dealer is going to pay one flat monthly subscription fee plus interest on the amount of used financing. And what that allows us to do is really align our interests with the dealer. We want our dealers to be turning cars over as quickly as possible. They have no incremental expense to floor that next car with our program. So we kind of have a self-selection around those best performing dealers who are turning cars over fast, and they have predictability around what their monthly expense burden is going to be for their floor plan. So that's a pretty unique structure. And frankly, it was a tall hill to climb when we got into the market, because a lot of dealers were like, a subscription for a floor plan? What are you talking about, man? But we've obviously dialed in how we present that, how we explain it, the materials to help educate dealers climb that hill with us. And we've also, as we've partnered with banks, we obviously, for banks that are just taking the technology and running with it, there's a traditional SaaS fee. But we also have banks who we're really helping guide and effectively support from a servicing operation perspective. And so those banks we've actually got using our subscription program as well, which they see the merits of. They got into the business because they heard about the complaints of the legacy players. And so we're able to really make it a win-win-win for us, our bank partners, and for their dealer clients, in the sense that the banks keep the interest income, which is a core revenue stream that they understand, and we're able to capture that subscription revenue that's paid by the dealers.
So these would be banks, credit unions, or specialty financing organizations, right? So those are strategic partners, I would imagine, for you guys. Curious to double click on what you just mentioned there. If they're not familiar with buying what you're selling in the way that you're helping them to buy, in other words, they're not familiar with I must pay a subscription. How have you been able to overcome that change in the way that your partners and, by extension, your dealers, typically buy something like this?
Yeah, I mean, this is where even till today, and we will continue doing this going forward, we have a constant emphasis on customer discovery, sitting with prospects and clients, listening to what they're confused by, what problems they have, what's, a challenge for them. And we either, come up with ways to better articulate the value of our program, and whether that's with marketing materials, explainer videos, generally the kind of sales playbook that we can use to educate our team and educate dealers, or educate our partners who will then educate their dealers. It's really, there's no substitute for investing in the relationships, both with your partners, with your employees, and with your dealers, or with your clients, and learning from those conversations and figuring out ways to better convey whatever that value proposition is that you're bringing to market.
So one of the things, John, you mentioned to me was that you've invested obviously very heavily in product development. So obviously, like most most startups. But what's interesting about you is that you've actually done a lot of this development offshore. And I'm very curious to spend a bit of time here, because when do you source your development offshore or not? You know what I mean? Like, there's things around who owns the IP, and then, blah, blah, blah. It can be a minefield if you don't know what you're getting into. What have you learned about or how to offshore your development successfully?
Yeah. Ultimately, this was a decision of our CTO. And we, Isaac and myself, the two original co-founders, really, Isaac's a product guy, but non-technical. And so we invested heavily in finding that right technical partner who was focused on building an MVP for less than $50,000, who had a clear path around what the timeline and requirements were going to be to build version 1 of our platform, and who was committed to doing it efficiently, without much overhead, and without being inclined to roll up his sleeves individually. With that being said, he had worked with offshore teams in the past. He had a playbook around how to manage those engagements effectively. And ultimately, what I've learned is the more you invest into the partner, the better the results that you're going to yield. So our CTO at least twice a year goes over and sits with our development team in Hyderabad. He has educated and implemented a DevOps operating model at the organization, which they viewed as a means of leveling up their broader operations outside of just the engagement with Vero. And, it's a great cadence where Rama is able to sit with our team at the beginning of our days and at the end of, or I should say at the beginning of his day and the end of his day, and provide that feedback and insight so that we have a relatively continuous development cycle. As that team has grown from 2, 3, 4 engineers to now more than 20, it's obviously required a variety of different organizational evolutions where we have sourced or identified folks within that team who have elevated their performance to take on leadership or team management roles. We have bi-weekly sprints, weekly touch bases between Isaac's product organization and dev team in order for them to really get dialed in on the end user perspective. But ultimately, Rama is masterful at managing that. And without him, we never would have been able to get comfortable with investing so heavily in our offshore operations.
Right. Is it something that you see yourselves continuing strategically on, or do you feel like it's something that you will bring in-house?
There will always be a component of our business that is offshore. The economic model, it's irrefutable. With that being said, we now are at a point where we need to get more of a team onshore to support the day-to-day problems that need to be addressed, the inevitable bugs, and frankly, just ramp up our capacity as we continue to move even faster and continue to expand our build out and development efforts.
Cool. So you guys closed your most recent funding round. You raised $4 million in March. How was that process for you? Was it something that you anticipated being as hard as it was? Or was it easier than you expected? Walk us through some initial experiences there.
It was brutal. Everyone said it was going to be brutal, and I was like, yeah, okay, we'll be prepared for it, but it was tough, especially for a business that has balance sheet risk. The reality and what we found is there's really two populations of investors, those that are comfortable with balance sheet risk and those who are not. And then even within that population of those who are comfortable, there's an even smaller population who are comfortable doing early stage investments. And what it came down to was educating them. It took time. We started it earlier than we expected, and it still went longer than we expected. But the beauty of investing so heavily in our seed round is a lot of those people that said, hey, we like your business, we like you guys as founders, but we need to see more proof points, more of a track record, just not right now, have since circled back with us, or we've circled back with them, or we've bumped into them at a conference, and now they're engaged leading up to our Series A. So, I think everyone says your seed round is the hardest. I sure as hell hope so. But it also did, it forced us to really refine our articulation of current business model and future plans. It forced us to really refine go-to-market strategy, and it allowed us to even come up with some new ideas around how we think about the business. So I still view every one of those conversations, well, almost every one of those conversations as being generally productive.
So how soon in the process do you feel like a startup should start this sort of capital raising process?
I mean, I think as soon as you have some validation or a clear path to validation within the next 3 to 6 months. It's great to strike out and start. I shouldn't say strike out. It's great to start or to set out and start having those conversations with VCs and say, hey, this is where we're at, and this is where we want to be 6 months from now, and these are the milestones we're going to hit. Because I think as a seed or raising for a seed round, nothing provides better validation than you telling someone you're going to do something. You go out and actually do it, and they're like, oh well, it's a little early, but these guys do what they say they're going to do, so I have a little extra confidence in them.
So why 4 million and not 6?
We're practical. We raised at a 16 million pre-money val. We thought that was fair given where we were at. It was 2021. I think you have some crazy people who can raise 3 to 5 million with a DAC. We had an operating system and traction and some revenue. And I think it frankly behooves us now as we contemplate when to go out to the market for our Series A, that we didn't have some crazy astronomical valuation for our seed.
Mm-hmm. So speaking of contemplation, do you ever contemplate the day of a liquidity event in the future?
I try not to let myself do that too often, but inevitably it's a nice thing to daydream about sometimes.
Mm-hmm. So curious on that. When do you start daydreaming about that stuff, or at least applying your mind into like how to structure this thing for a liquidity event? Because often I found like, sometimes you can actually leave it too late. Like I know you're in this raise, but you have to actually think, well, hang on, how many more, are you going to get to like Series B and then start? You know what I mean? Or do you wait another 2 years till Series D? You know what I mean? Like timing is important. So like, when do you start thinking about that sort of stuff?
I mean, I've started now. I've started since the seed got done. I think, we heard pushback around different parts of our business. And as we've heard pushback, or as we've heard, how do you focus more on the technology and less on the balance sheet? How do you think about what a potential acquirer looks like? How big do you want to take this? Those are questions that I don't necessarily have a fully baked answer to today, but I've definitely thought about. And so we think about contingency planning. If this, then what happens there? Or if we go down this path, what does it mean for the other parts of our business? So I think actually you don't commit to any plans when you're a seed or Series A stage company, but you do have an understanding of what those different outcomes look like and what those inflection points are when you commit to one path or another. So we're mindful of them, but we are still in a place where we have a ton of growth to do, a lot of building to do. And ultimately, I don't think we have to commit to a plan for another 24 to 36 months. And that still is well in advance of any type of exit event. I mean, there's a reality where we run this business for the rest of our careers. We love the organization we've built. We love the people that we've gotten involved. And we like the idea that we can continue to grow this thing to be, cash flow positive in the nearish term, but ultimately a self-sustaining place that we're really proud of as an organization that people want to come and work for.
Mm-hmm. So speaking of people, who's on your team? Like who are the captains on the ship?
Yeah, we've been very mindful of building out a mix of experienced industry operators who have done inventory financing in a variety of capacities at those legacy players who understand the pains of the existing systems that people use and the operating models that are frankly hamstrung by those systems, as well as product, startup, technology-oriented folks who come from backgrounds of growth stage organizations that have been scrappy, who have moved quickly, who understand, the ambiguity that needs to be navigated given the life stage that we're at. So what I really love about our team is, we have folks who have been around the block who have really seen how this shit gets done, and they kind of define, here's a problem, and this is the general solution or the requirements of the solution. And then our technology and product folks say, okay, how do we re-engineer a process or a tool or a system that takes advantage of the latest and greatest technologies that we have access to achieve either that same outcome or a better outcome than what was previously achievable in the experienced operators folks' prior lives.
It's interesting when you think about the way things, or maybe for context, so everything is the way that it is because someone changed it from the way that it was, and usually that person's like an entrepreneur. That's my view. And then
Yeah.
what's interesting from your perspective, it's like, well, one, you didn't really, like, you didn't spend 25 years in this space, you know what I mean? And then go, oh shit, there has to be a better way. It was actually coming in relatively clean, and meaning you didn't have, you just knew that there must be a better way, but you didn't know what that was. That's the visionary, right? You're just trying to figure that stuff out and connect all the dots in your mind and then build something that can ultimately get there. And then what you've done is you're bringing in people who are familiar with the way that it was and has been for so long, and you're bringing them into this new culture and this new idea, right? To say, hey, bring your expertise, your subject matter expertise from the way that it was, and we want to now change the way that it is moving forward. So lots of preamble there, but the reason why or the question that I have rather is, how much of an advantage do you feel it actually is not knowing what you're getting into versus bringing people in? It's like Apple hiring people from Motorola. Like, would they do that, or would they hire, you know what I mean? Like, to get the innovation cycle going. Like, it's different mindsets, isn't it? So I'm curious to get your view on that.
It's a delicate balance that needs to be maintained. Ultimately, especially in a lending business, you need to have some gray hairs who have seen how stuff gets done and what are the messes and how to navigate those. I think a decade ago, in that original generation of peer-to-peer lending platforms, it was probably more of the traditional focus on growth, focus on top line revenue and origination volume, and worry about portfolio performance after the fact. And for us, we've taken the model of the best way for us to grow is to couple moving relatively quickly and being growth minded while also being relatively risk minded, because frankly, the insights that I gather from our team of operators are adding, it's impossible to put a dollar value on the value that they're contributing to our product roadmap. There are so many gaps that if you try to just dive into the deep end and build something that you think is, it's the whole Henry Ford adage of, if you'd asked them what they wanted, they would have said faster horses. Like, yeah, sure. But if you had showed them a chassis and allowed them to drive without a horse, like, they probably would have had some product insights around exactly what needed to be accommodated in terms of user requirements. And so this gets back to our focus on customer discovery. I think, we see the Leverato team as, again, customer number one of Vero. And so we need to make sure that we meet their needs, because ultimately their needs are very similar to the needs of our bank partners that we're implementing with. And so I think I put a heavy emphasis on user-driven development rather than moonshot innovation.
And yeah, so let's unpack that, because I think this is actually something we wanted to talk about, wasn't it? It was around the fact that you guys have overinvested, quote unquote, into customer discovery, and then there was the faster horse story. So why is this so important to you? Like, the customer I mean, it's kind of self-implied for those of us who haven't been in the space for more than about 1 month. But then basically the way I want to go with this is, like, there's two types of innovation, isn't there? Like, I forget the term used, but like visionary innovation. It's like Steve Jobs created the iPhone. If you went to any consumer in the world and said, hey, what do you want next? Like, you never would have got the iPhone. So that's the visionary innovation space. And then you've got this customer innovation space. Surely and maybe this is about getting that balancing act right, like you mentioned, like getting the right people from the way that it was the incumbent space, because there's lots of knowledge there. And then I suppose getting that customer innovation also mapped correctly to the vision that you're trying to create, isn't it?
Yeah, I mean, I think it comes down to a few realities that whoever the entrepreneur has to accept. To do the visionary-led innovation, inevitably it's going to be a bigger bet on a crazier outcome that's slightly higher risk from an execution standpoint. In our view, customer-led innovation was a bit of a hedge, because we ultimately are tackling a existing market with an existing product, but we believe the way we can deliver that product can be wholly differentiated based on the technology that we're developing. And so the fact that we moved so quickly to get a product into the market, when we launched, we were using a JOT form to handle funding requests. Um, and so, but those initial loans that we funded informed even, at that point in time, we didn't even have a floor plan expert on the team, but funding those initial loans allowed us to navigate how to build the right piping to support going from 5 loans a week to 100 loans a week to 1,000 loans a week. And so that was a critical kind of crawl before you walk process. So, we wanted to work towards a path where we could get to cash flow positive in a much tighter timeline than may have been the case with any fintech startup 5 or 10 years ago. We wanted to get to a case where we could really prioritize feature development based on customer feedback rather than what our product team thought was going to be the coolest, shiniest tool. And again, this is the nature of us operating in an existing market and trying to displace the existing competitors rather than necessarily go out and create a new market in a greenfield. So I think there's different approaches based on the model you're trying to enter, based on the competitive environment, based on what your go-to-market path looks like. But also this kind of goes back to back to Vero. We knew that we needed to have a successful track record of a client using our systems before a bank was ever going to be ready to jump on board with us. And so Lever, in a way, was also it was grease on the wheel for us to get those initial bank contracts.
Mm. So what's your vision here, John? Like what's the ultimate contribution that you hope to make to the world through this startup?
I mean, I want to make a meaningful impact in the industry that we operate in, and that's dealers of manufactured goods, community, regional banks, and credit unions, and ultimately the other tangential stakeholders who are involved in our market. I think, the dealer world is generally underserved and maybe has a slightly bad stigma associated with it. But ultimately, our platform is going to be a means that we want to do more than just floor planning. We really want to think about how we can better meet the broader financial needs of our dealers beyond just providing inventory financing. So whether that's, thinking about business banking services, debit and credit card, loans for real estate transactions. The beauty of the inventory financing is we have a very high level of engagement with our dealers where they're buying and selling cars or boats or whatever it might be on a daily basis, and they're consistently engaging with our platform for services. So our bank partners love it because they then can use that high level of engagement to identify other financial needs that they can support of those businesses. And we can then provide a platform where, perhaps a dealer is not big enough to qualify for a bank floor plan line today, but they can grow with us. We can support their broader financial needs, and they can ultimately graduate to our bank partners in their local markets over time. So really, it's providing this holistic financial services platform for a niche that is not a small segment in our universe or our economy. In auto alone, there are more than 65,000 dealers in the United States. And that doesn't even contemplate the ag dealers, the marine dealers, the RV dealers out there as well.
Very, very interesting. So I'm going to have a bit of fun with you now, John. But if I could give you the keys to the Matt Brown Show time machine and ask you to go back to day one, and if you think about all the things you've learned, all the things that you've achieved, all the things you failed at, what would one piece of advice be, that you would give yourself about building this business?
I think the one thing that I've learned the hard way that I wish I would have known is it's going to be a roller coaster ride. So just buckle up. But the downswings are never going to last as long as you think they are. And inevitably, in a relatively short matter of time, generally, knock on wood, this has been the case for us so far, something shifts and you start that upswing again, and it gets really damn exciting. So that's probably my biggest learning or takeaway that I've tried to remind myself of today.
Very cool. Very cool. Yeah, it's a bit like it's not exactly like a hockey stick, is it? It's kind of more like a stock market graph, and then you must just kind of try and like not slit your wrists when things get bad.
As long as those downswings aren't as low as they were previously, you're still on your way up.
Yeah, absolutely, absolutely. So John, let's wrap this up. Why do you do what you do? Like you could go. Obviously, you're a smart guy. You could solve any problems, really. What gets you out of bed in the morning?
Honestly, I love working with my team. We're at 17 today, and we all have fun working together, even during the shitty weeks. And I think that was kind of an objective that I set for myself, for us, when we got started, is to build an organization that we're proud of. And the fact I'm responsible for all the bad things that happen. We're responsible for all the good things that happen, is kind of the mentality around here. So we really try to support our people, create a place where they're never going to want to leave, create plans for them individually to expand and pursue whatever ambitions they have. And it makes navigating the tough stuff a lot easier, knowing that we have each other's backs.
Awesome stuff, man. Well, look, John, it's been a privilege having you on the show. Very excited to see where you guys are going. I've been, as I was telling you when I first met, like I've also been in a similar lending type platform and services with like underwriting services around it. It's a very interesting space. And I think what you guys have achieved in such a short period of time is really remarkable. So super excited to see where you guys are going to go.
Thanks, Matt.
Thanks, everyone. Cheers for now.